Now let's talk about long-term liabilities. Long-term liabilities are usually part of most companies' capital structure. Long-term liabilities are used to fund long-term assets. And if you borrow from the public, right, you're going to issue bonds in capital market. Alright, so we do have other long-term liabilities. For example, we have long-term pension obligations. These are liabilities to employees. We have leases and deferred income taxes. Debt securities. We talk about debt securities. We're going to have bonds and notes. Okay, those are typically traded in the market, and they enable companies to borrow large amount of capital. Right? If you borrow capital, it's better to go to a bank. And if you issue bonds, right, it's going to be a little bit more expensive because bonds are public securities and you have to go through the SEC. Okay, we have basically two payments. If you have debt securities, two payments. One is a face amount, also known as the principal amount of loan you're going to repay in the future. We also have periodic interest payment, and usually they're paid semi-annually. When we issue bond, there are two interest rates to consider. One is called a coupon rate. This is the interest rate based on which the borrower is going to pay interest to the lender. So this coupon rate is used to calculate interest payment. And the other interest rate is called market rate. This is a rate that investors expect to earn on a debt at the date of issuance. This is also known as a yield rate. So depending on which rate is higher, the bond may be issued with a premium, which means the issue price will be higher than its face value, or issued with a discount, then the issue price will be lower than its face value. Okay, when the coupon rate is higher than market rate, right, the bond is offered higher rate than what is expected by an investor. In this case, the bond will be issued with a premium because it's good investment, right? When the coupon rate is lower than market rate, right, you offer lower than what has been expected by investors, then this bond will be issued with a discount. When these two rates are equal, the bond will be issued at its face value. No premium, no discount. Okay, reporting bonds on the balance sheet. Typically, we're going to report its face value, okay, and either a discount or a premium. If the bond is issued with a discount, we report both the face value and discount, then we have a net bond payables. See, this is lower than the face value. If we have a premium, right, the bond payable will be higher than its face value. Once we have the bond, how do we report interest expense? Interest expense reported on income statement. And they represent the effective cost of debt. Now, if we have bond typically with a discount or a premium, then interest expense typically has two parts. For example, if we have a discount, the interest expense equals cash interest paid. This is based on the coupon rate plus amortization of discount. Remember the one bond issue with a discount, right? The amount of discount will be amortized into interest expense. This becomes effective cost of debt if they are issued with a discount. Okay? If bond issued with a premium, then the interest expense equals the cash interest paid less the amortization of premium. So the bond issued with a premium, it's a benefit for the issuer. On the other hand, bond issued with a discount, right? It's going to add cost to the issuer. Discount. Debt ratings. So how do we determine the expected return for investors? So what to determine the market rate? That's from the debt ratings. Okay, this is often referred to as credit quality or credit worthiness. The debt rating is an evaluation of company's default risk. Default means, okay, when interest and principal are not paid, okay, or the covenants of bond indentures are violated. So there's some covenants saying, okay, you can't, right? You can't pay dividend. If you pay dividend, you violate the covenant. It's also default, but typically it's about interest and principal payment. If you couldn't pay, right, you default. That's default risk. The rating agencies assign ratings to debt issuer to inform investor about the issuer's default risk. Right? The higher default risk, the more risky the debt securities will be. Right? So there are many agencies, debt rating agencies, but typically we have Moody's, right? We have SP, and we have Fitch. Those are the typical rating agencies we have. And this described how the securities are rated. Now basically the idea will be the same. For the maximum safety, Moody's is AAA rating, right? There's both a AAA ratings, and for high grade, high quality AA, starting with B, we have speculative, and rating C means exceptionally high risk. Rating D means default. And typically, if the rating is below BBB, they're non-investment. Okay, we call them junk bond. Those are bonds. The interest rate are extremely high for junk bond. What are the factors that is going to affect debt ratings? Okay, in addition to the issuer's risk. Collateral, if we add collateral to the debt securities, it's going to increase ratings. Collateral means it's a securities. Once a company is default the payment, they have collaterals which will be used to make payment to lenders. Covenants, those are restrictions specified in the debt agreement. The more covenant, the more safeness, right, offered to the lenders. We also have options. Those can be written into the debt contract. For example, the options we have conversion options, right? Those debt securities can be converted into equity securities. We can also have call options. All these is going to affect the debt ratings. Alright, now let's move to the equity part. Advisors, stockholders' equity have two main parts. One is contributed capital and the other is earned capital. Contributed capital is invested by investors. So we have preferred stock, common stock, additional paid-in capital, right? Treasury stock. Talk about that. Treasury stock is repurchased by the company. It's going to reduce their equities. And earned capitals, retained earnings, accumulated other comprehensive losses or gains, and we have the total. Okay, that's a basic component of stockholders' equity. So let's start with contributed capital. Contributed capital represents, right, the cumulative cash inflows received from issuance of various classes of stock. Basically, these are invested by investors, less the net cash paid out to repurchase company's own stocks from the market, and this becomes the treasury stock. The two classes of stock company typically issue are common stock and preferred stock. And we're going to talk about that very soon. And any issue price in addition to the par value of common stock or preferred stock will be recorded in additional paid-in capital account. So therefore, it's also known as paid-in capital in excess of par. Right, and earned capital, we have retained earnings, we know that. And this is accumulated other comprehensive income. Okay, these are changes to equity which are not part of the income. Therefore, they are not shown in income statement. Rather, they directly shown in the equities. So if we have right, if we have gains, that's going to increase our equity, this account. If we have losses, it's going to reduce this account. So what are the examples we have for accumulated other comprehensive incomes? We have foreign currency translation adjustment. Right, if company holds a lot of foreign currencies, right, due to the fluctuation of exchange rate, may have gains or losses. These are not shown in income statement, rather it's going to show in this account. And we have unrecognized gains or losses on securities, typically on available for sale securities. Okay, because again, price fluctuations. If we have those securities, price goes up, we have gains. Price goes down, we have losses, but we do not report, right, those gains or losses income statement. Rather, we report gains or losses in this account. And a certain pension adjustment, the same thing. We're going to report gains or losses in this account. Now let's talk about contributed capital, common stock. This is a primary ownership, and common shareholders is going to own common stock. Or the other way, if you purchase common stock, you become common shareholders. Typically, common shareholders have voting rights. Okay, when we issue common stock, we're going to have a par value. Par value is arbitrary value assigned to each share of stock. Typically, the par value does not have economic meanings. right? The par value will be used in the allocation of proceeds from stock issuances. So we're going to allocate basically the proceeds into the common stock and additional paid-in capital account. And we allocate par value into the common stock account, which we're going to talk about the journal entry very soon. And the preferred stock, right? This represents preferred shareholders' rights compared to common stock. Preferred stock generally has some preferences or priority. For example, typically they have dividend preferences. Preferred shareholder is going to receive dividend before common shareholders. Also, they have liquidation preferences. The company fails, right? Asset sold. Well, in liquidations, go first to pay creditors for sure. Next, it goes to preferred shareholders, and finally to common stockholders. Typically, there's nothing left for common stockholders. And like debt securities, preferred stock is also contract-based, so we can add many features into preferred stock. Therefore, we have very unique features for preferred stock. For example, we have call features. Right, the issue may have the right to repurchase preferred stock from shareholders. Right, it can have conversion features. Right, for example, preferred stock can be converted to common stock, and it has participation features which allows preferred shareholders to share ratably with common shareholders in dividends, so they have more chances than the common stockholders to share dividend. But in order to have all these rights, typically preferred stockholders, they give up voting rights. They cannot vote. Okay, common stockholders can vote, but preferred stockholders cannot vote. As a return, they have a lot of preferences. Here we have a disclosure of a Fider's preferred stock disclosure. During the last financial crisis, many companies issued preferred stocks to the U.S. government, right, as a way that they can be saved by the government. Why not common stock? Why not common stocks? Because they don't want government to get into the private sector. There's no voting rights. They just invest money and get a dividend, and that's it. They cannot vote. All right, let's talk about the journal entries. Now, we have seen the journal entries already, right? In some places. And typically, we're going to consider the par value first, and remaining part will be recorded into this additional paid-in capital account. And here we have an example. Right, this company issued 500 shares of $1 par value common stock, $15 per share. Therefore, the total proceeds from the issuance was 15 multiplied by 500, right, which is a cash amount, 7,500. So we debit cash 7,500. It's total proceeds. So we can allocate the total proceeds into two accounts. First, the common stock account. We credit common stock, so we're gonna record the par value from issuance into this account. That is $1 per share multiplied by 500 shares, or $500 will be credited into common stock account, and the rest of the proceeds will be credited into this additional paid-in capital account, $7,000. And the journal entry will be the same if we issue preferred stocks. Okay, just to credit preferred stock with a par value from issuance, then the remaining part will be credited into additional paid-in capital account. same thing. Okay, common stock prefer the stock to increase equities, and the stock repurchase is going to reduce company's equities. So how it works? Company, just like human beings, can buy stocks from the market. Many reasons for this repurchase, and typically this repurchase is going to reduce number of shares outstanding. Okay, if we reduce the number of shares outstanding, it can increase the per share value, right? Because the pie will be the same. The company's pie will be the same, but we have few slices because we repurchased a few slices, so each piece of the pie will be larger. The value will increase. This is a way that a lot of companies try to push up their stock values, right? If they couldn't give shareholders return from their operations, typically when the business matures, it's very difficult to find to support the high growth mode, right? If that is the case, most companies will use their cash to repurchase their own stock from the open market, pushing up the share price. Okay, once the stocks are repurchased, it becomes treasury stock. So the company is going to report treasury stock on their balance sheet as reduction of their equities. And treasury stock are recorded at the cost paid. The accounting for treasury stock. Right, if a company holds a treasury stock, it can also resell those treasury stock to investors. So there are buy and sell transactions of treasury stock. Just like inventories, the company may have gain or losses. However, we never record gain losses for these type of transactions, equity transactions. Instead, okay, these gains and losses is going to reflect in company's equity account. So if they make money from treasury stock transactions, increase their equities. If they have loss, they reduce their equities. Right, this is your Pfizer's repurchase disclosures. The company disclosed how many shares they have repurchased and the cost of purchase. Right, so let's take a look at the journal entries. So the company repurchased 100 shares of its own common stocks, $22 per share. So we credit cash 100 multiplied by 22 or 2200. Right, credit cash. And what we debit is we're going to debit treasury stock. This is a contra equity account. It's an equity account, but it's going to show as a negative equity, 2200. Okay, on the balance sheet, this is going to report it on the balance sheet in the contribute capital section, or at the end of the equity session. Later, the company sold or reissued 80 shares of the treasury stock for $24 per share. Remember, the company repurchased at 22, now they're selling at 24, so they are making $2 per share. Okay, $2 per share. I call it profit or gain, but right, in equity transactions there's no gain. It's rather it's going to increase the company's equity by $2 multiplied by 80 or $160 increase in their equity. So the transaction, we debit cash for sure, we credit treasury stock right, at the cost, right? That's 80 shares multiplied by $22. Remember, we repurchased at $22. And the 160 is a gain, so-called gain we made from this reissuance. And this increase additional paid-in capital account. Additional paid-in capital account. All right, now back to earned capital. Earned capital, we have return earnings. Return earnings, accumulated profit that has been retained by the company. Basically, the net income accumulated. If we haven't paid out dividend to shareholders, right, we have return earnings. It's going to increase companies by company's net income. If we have loss, it's going to decrease return earnings account. If we pay dividend to shareholders, it's going to reduce our earned capital. And we have cash dividend, we have property dividend. Okay, we can also have stock dividend. These various dividends are going to reduce companies' earned capital. Right? And also it's going to increase or decrease by the accumulated other comprehensive income, AOCI. So we talk about that already. Right, so cash dividend is the most popular dividend. So how to record a cash dividend? Cash dividend is going to reduce our retained earnings. So for example, the company declared and paid a quarterly cash dividend $780. So we're going to debit retained earnings $780, credit cash. That's it. And sometimes we're going to see an account called a dividend account. Okay, the dividend account is a contra equity account. It's going to reduce company's retained earnings for sure. The same thing. Right, to understand accumulated other comprehensive income, then we need to understand what is comprehensive income. Right, comprehensive income, this is a more inclusive notion of company's performance than net income. So it include everything that's going to change company's equity, including net income. But sometimes comprehensive income include effects that are considered outside management controls. The net income is under management controls, but other things are outside management controls. For example, we have exchange rate fluctuations, right? That's out of management controls. So if we have fluctuations, exchange rate fluctuations, we have foreign currency adjustment. So I will talk about that. If any unrealized changes in market values available for sale, debt securities, okay, is also comprehensive income. But these other things we call other, right? We call them accumulated other comprehensive income. Together with net income, they become comprehensive income. So in the statement changes in stockholders' equity, we're going to show the company's change in the equities by various components. Right, we have preferred stock, common stock, additional paid-in capital, treasury stock, return earnings, accumulated other comprehensive incomes, Okay, all these are going to change companies, the shareholders' equity. Sometimes we also have non-controlling interest, non-controlling or minority interest. Okay, and these are going to also affect, together with the shareholders' equity, they become the company's total equity. So this is also a change in company's total equity from a non-controlling interest or minority interest. In previous lectures, we talked about return on equity, the ratio measure that is measured for all shareholders on total equities. If we stand on common shareholders, look from the common shareholders' perspective, right? A better measure for common shareholders is a return on common equities, ROCE. These are return on investment made by common shareholders. Similar to ROE, certain effect or certain capital are removed. So any effect from the preferred stocks and a non-controlling interest are removed from both the numerator and denominator. So this is purely measure for common shareholders. So ROC increase net income available for common shareholders, right? Divided by average common shareholders equity. So how do we get net income available for common shareholders? Well, that's net income less any net income attributable to non-controlling interests less preferred dividend. That becomes the net income available for common shareholders. To get to the common shareholders equity, that's total equity less, right? Equity to non-controlling interest less any preferred stock equities. So what's left is common shareholders equity. Alright, this is how we calculate ROCE for Pfizer. Get a comparison to its competitor, Merck. And a comparison among various industries. Look at PepsiCo, right? Its return on common equities is extremely high. Okay, another ratio we can use is called book value per share. Book value per share, again, this is net book value company is available to common shareholders. So on the numerator, that's equities, right, to common shareholders, the total equity less preferred stock less non-controlling interest, divided by number of common shares outstanding. Common shares outstanding. Okay, another ratio we often use earnings per share. Typically, the two earnings per share will be required for income statement. One is a basic earnings per share. These are net income available for common shareholders divided by weighted average common shares outstanding. Right? This is a basic earnings per share. We also have a diluted earnings per share, which is required if company has complex capital structures. For example, any stock option and restricted stocks, potentially they're going to dilute, right? They're going to dilute common shares outstanding. Therefore, these effect will be considered in calculating the diluted earnings per share. Okay, Also, any convertible securities which can be converted into common shares. Convertible securities, their effect will also be considered when we calculate diluted earnings per share. So these are the two earnings per share, basic and diluted. So we talked about that already. Dilutive securities, these are securities can be converted into common stocks. They're converted, they're going to increase, right? They're going to increase the denominator. So we're going to reduce the earnings per share measures. So typically we have stock options, convertible debt, convertible preferred stock. Well, these are going to be dilutive securities. This is example of Pfizer's earnings per share reporting at the end of income statement. Earnings per share, you have basic earnings per share. They right from continued and discontinued operations, the total earnings per share. And because the company has a complex capital structure, it's going to also report a diluted earnings per share. Typically, it will be slightly lower because the denominator, right? After we consider this diluted effect, the denominator will be larger. Number of shares will be larger. The weighted average shares diluted typically will be larger than the basic number of shares. Right, so that's everything we have, and we only cover selective, right, topics from those two chapters. Okay, many materials has been cut because of the complexity involved. So anything covered by the lecture notes will be required for exam purposes. If you're interested, you can always read the whole textbook.